Financials are surging, up 1.4% this week, with a bullish trend driven by key catalysts, but looming risks threaten to disrupt this momentum. This is what every serious investor needs to know about financials right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. As we begin this week, market conditions are generally stable, with the VIX at 19.6, indicating normal conditions. This stability is a positive backdrop for a deep dive into the financial sector, which has been performing relatively well. In the context of the S&P 500 this week, financials stands out for its resilience, and the sector ETF, XLF, has shown a notable gain of 1.4%. This performance deserves attention, especially given the sector's significance in the overall market. The financial sector is a key indicator of economic health, and its trends can provide valuable insights into the broader market dynamics. With its current momentum, it is essential for investors to understand the underlying factors driving this sector's performance. Please remember, this analysis is for educational purposes only, and not to be considered as financial advice. Let us start with the technical picture and what the charts are telling us. The financial sector, as represented by the XLF ETF, has been demonstrating a bullish signal with a weekly change of 1.4% and a monthly change of 0.89%. The Relative Strength Index, or RSI, is currently reading 53, which implies that the sector is in a neutral to slightly bullish territory, suggesting that there is still room for upside momentum. This reading indicates that the sector has not yet reached overbought levels, which could potentially lead to a continuation of the current trend. The trend direction is clearly upward, with increasing conviction, as the sector has been able to maintain its gains over the past week. Key support levels likely exist near the recent lows, while resistance levels may be found near the recent highs. The current move appears to be a sustainable breakout, rather than an extended overreach, as the sector has been consolidating its gains through a series of higher lows. A specific technical setup worth watching this week is the potential for a further breakout above the current resistance levels, which could lead to a continuation of the uptrend. Now let us look at the fundamental catalysts driving this sector. The financial sector is poised for a pivotal week, with key macro events on the horizon, particularly the CPI inflation report and the FOMC rate decision, which will undoubtedly influence the trajectory of this space. The current market regime, characterized by normal conditions and a VIX of 19.6, suggests a moderate level of risk appetite, which could bode well for the sector. Key stocks such as JPM, BASF, WFC, and Berkshire Hathaway are signaling a relatively healthy sector, with many of these institutions having demonstrated resilience in recent months. From a fundamental perspective, the sector is likely to be driven by the interplay between interest rates, lending activity, and asset management fees. The upcoming economic events will provide crucial insights into the inflation landscape and the Federal Reserve's monetary policy stance, both of which will have a direct impact on the financial sector. With no major earnings reports scheduled for this week, investors will be closely watching regulatory news and macro data for clues on the sector's direction. The longer-term fundamental thesis for being positioned in this space remains intact, driven by the potential for rising interest rates to boost net interest income and the growing demand for financial services. Next, let us talk about the specific risks you need to manage this week. This week, financials investors face significant risks, primarily stemming from regulatory uncertainty, geopolitical tensions, and potential interest rate fluctuations. Given the current volatility environment, with the VIX at 19.6, it is essential to think carefully about position sizing, as even moderate changes in market sentiment can have substantial impacts on portfolio values. Unexpected headwinds, such as unanticipated central bank actions or unforeseen economic data releases, could also affect the sector. To manage downside exposure, investors should adopt a disciplined framework, incorporating thorough risk assessments, diversification, and stop-loss strategies. By doing so, they can mitigate potential losses and protect their investments. A well-structured approach to risk management is crucial in the current market environment. And now for the strategic outlook, where does financials stand heading into next week? Our strategic positioning for financials this week is cautiously bullish, driven by improving earnings trends. A key theme to track is interest rate sensitivity, which may impact bank performance. Please remember, this is educational content and not financial advice. For more insights, like and subscribe to Financial Market Oracle, and comment your financials watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.